First of all, we need the purchase price. Okay, got to include that. Secondly, we need to know how you intend to finance the property. Will it be cash? Will it be conventional? Will it be seller financing? Will it be private money, third-party funding? How do you intend to finance the deal? Third thing that the offer needs to include is your down payment. Are you going to put any money down? The fourth thing is who pays what closing costs. Now, closing costs are typically shared, not equally, because the seller has costs that do not attribute to the buyer. One of the big mistakes I see a lot of investors making is they will write right into the contract that we're going to split the closing costs. Guys, that's a terrible idea. And if you're doing that, you should read a book called Never Split the Difference, which was one of our Book of the Month clubs. But you should never pay the seller's closing costs because their closing costs are higher than yours. So here's how you address it. You simply say, look, you cover your closing costs on the sales side. I will cover my closing costs on the buy side, and everybody wins. Okay. Next thing we need, what inspections are going to be performed? Now, I do not recommend, guys, ever purchasing a piece of real estate without having a third-party, unaffiliated inspector go through the property and get you a full-blown inspection report. Now, some of you have been out here to Coeur d'Alene. You spent 3 days with me and my team going through one of our master level classes called Lee's Inner Circle. In a Lee's Inner Circle, we will walk you through this entire process and show you exactly how we have gone through and purchased hundreds. I mean, we've flipped almost 150 homes this year, you guys, and we'll walk you through our process. But one of the big points of our process is the third-party inspection. So we get it under contract, hire an inspector, goes out to the property, takes photos of everything, crawls around, notates all of the problems that they've identified in the property, and then we use that inspection report to go back and negotiate better pricing based on the issues we found in the inspection. Now, every Monday morning at 10 a.m., I have a meeting with my acquisition team. And we had what appeared to be a great property under contract at a reasonable price, but then we got the inspection back. And right down the center of the foundation wall, huge crack, like 2-inch crack, all the way down the foundation wall. Now, the seller was willing to just do seller financing, but the reason the seller is willing to do seller financing is because the house was unfinanceable because that foundation makes it unfinanceable. No lender on the planet is going to touch that crack. Now, it is something that Kogo Capital would finance, but we are going to earmark the money necessary to repair the crack, which basically means jacking up the house, cutting out that portion of the foundation wall, reforming it, new rebar, and then repouring it, and then setting the house back on top. Not a difficult process, but you're looking at probably 3 weeks of labor and roughly $25,000 to $50,000 in costs to repair that thing. And only then will it be financeable. All of these things come, you guys, as a result of getting the inspection. So if you are going to write your own contracts and you're not going to use CenViews, then you need to make sure that you include the subject to inspection by licensed, bonded, third-party home inspector. Next thing your contract must include are your timetables. How long do you have for inspection? How long do you have for financing contingency? How long do you have to close? All of these things must be included. We also need to address personal property. Are there things in the home that you either want or that they want? If it is not attached to the property, like washer, dryer, like refrigerator, like microwave, if it is not attached, it is personal property. And personal property must be dealt with in the purchase and sale agreement under the personal property addendum. So if you don't say you want it, it's theirs and they will take it with them when they go. Conversely, if they don't say they want it, there's an argument that could be made that it's yours. So again, if it's not in writing, it's open to interpretation by both parties and everybody thinks they're right. So make sure you include personal property, what you want, what you don't want. Now, I will tell you this. One of our really successful negotiation strategies with landlords, properties that are in significant decline, disrepair, or where we have hoarding situations, is we will write into the purchase and sale agreement that the seller can take anything with them that they want, and they can leave anything that they don't want. So you do not have to clean the house. You do not have to hire a dumpster or a dump trailer or a 1-800-GOT-JUNK type company to come in and clean out the house. We will take care of it. And if you guys have the ability to offer that to a prospective seller, it really sets you apart from your competition, because we will buy it as is, where is, and we'll take care of whatever you don't want. So the way our contract reads is take whatever you want, and whatever's left, we will deal with it. But understand that when we deal with it, we're probably going to throw most of it out. Okay? Then we need to address the terms of the cancellation. We also need to cover when each party will get possession. So when is the seller going to vacate? When is the current occupant going to vacate? When do we get possession? Now, my acquisition team just came back this afternoon from an appointment on a property that's in a really good area, relatively new construction, worth about $390,000, and they got it under contract for $240,000. That's $150,000 below value. Why? Well, it's an estate sale. And in the estate, one of the kids has been assigned overseeing the disposition of the assets amongst those in the estates. And one of them is a family member who's still living in the home. So our purchase and sale agreement is subject to us keeping the occupant in the home for the next 12 months at a monthly rental rate of $300, and we get possession October 22nd of 2022, which means we got to keep the tenant in there for an entire year. And some of you are thinking, well, that's not a very good deal. Why would you do that? $300 a month, you can't make any money on that. Guys, if we simply take the cap rate of, let's call it 12, right? A 12 cap would require monthly payments of around $1,800. You take $1,800 less the $300 that they're giving you, you're running a $1,500 per month shortage. Over a 12-month period is 18 grand. So we simply agree to a price, let's call it $240,000, and then we account for the missing rents, and we simply discount the purchase price by $18,000 to offset the negative cash flow on the monthly rental income. Make sense? So it can be done, you just have to do the math. But this is why access, or gaining possession, when do we physically get possession? That's why this is so critically important. Then lastly, the thing that must be included in a purchase sale agreement is any repairs you want performed and which professional services will be used. So for example, in our market, we pretty much do everything except electrical and plumbing. So if there's electrical or plumbing work that needs to be done, we will get bids for that work and include it in our proposal. But any repairs you want performed by the seller would also need to be negotiated here. Now, when you are writing the offer, there's another thing called a dispute clause, and you need to know who's going to be paying for legal matters in the event they should arise. Okay, now again, guys, all of this is part of any typical standard generic purchase and sale agreement. You simply need to be aware of it, be aware of how to fill it out. If you're writing your offer out of CenFuse, all of these things are already accounted for. We've checked the right boxes, we've put in the right dates. So all of this is done for you. So CenFuse users, you're good. Anybody else, be aware, okay? Now let's talk about pricing strategy. How do we get the best prices? Well, we begin by anchoring appropriately. Now, before you write the offer, you need to work on anchoring the selling price. And we do this by subconsciously anchoring the price by talking about your research in the neighborhood and what the houses are worth. Ask them what the assessed value is, because it's almost always lower. And finally, if you ask them this question, if I pay you all cash and pay you quickly, what is the least you can accept? And then follow with the, is that the best you can do question.